Welcome back to Part 3, Video 2 Halves. In the first half we covered policy shifts. Now, let's look at the corporate moves shaping prices, pay, and products. Then we'll finish with the broader money culture shifts and our full weekly conclusion. Alright, to summarize this section in relatable terms, government actions this week are poised to make some things more costly, cheap imports, EVs, but also aim to protect or empower consumers in the financial system. The US is balancing protectionism with consumer cost, tariffs protecting domestic industry versus raising consumer prices. The UK is trying to balance supporting households with fiscal responsibility, finding revenue without broad tax hikes, tweaking regulations to boost competition. For you, the individual, it means staying aware of policy changes, maybe adjust your online shopping habits, seize limited time incentives like EV credits, and take advantage of the more competitive banking offers that regulators have nudged into existence. Shop around for that savings rate. Also, as always, tax policy is changing. No new tax laws this week, but the rumblings suggest that by year's end we could see shifts that warrant year-end financial planning. For example, if any new deductions or credits are introduced or if some taxes might rise in future, you might want to use available allowances now. We've covered policies and rules. Now, let's zero in on specific companies and industry moves that hit consumers, from banks making changes to businesses affecting our everyday money life. Notable corporate moves affecting consumers. Companies can influence our personal finances almost as much as government policies, whether it's your bank adjusting interest rates or a big employer announcing wage changes. This week saw several corporate moves that could impact consumers in the US and UK. Banking and fintech. Consumer-friendly moves and some caution. As mentioned earlier, major US banks reported that consumers are in good shape. But let's talk about what banks themselves are doing that affects you. With interest rates high, banks have been engaged in a quiet battle for deposits. We're seeing some attractive savings account offers. For example, a few online banks or credit unions in the US are advertising savings yields around 5% APY, exceptionally high by the standards of the last decade. That's partly a response to competition. People can easily move money to treasury bills or money market funds these days for 5% yield, so banks have to up their game. One noteworthy thing. A list of best savings rates showed at least one account at 5.00% APY as of September 9th. If you're still earning like 0.5% at a megabank, that's a hint to shop around. The big banks, Chase, B of A, etc., largely count on customer inertia and still pay paltry rates on many checking, savings accounts, but they do offer special high-yield products via their online arms or partner banks. For instance, Citigroup's online bank, Citi Accelerate, or Goldman Sachs Marcus often have better deals. It's a bifurcated market. Informed consumers can get 4–5%, uninformed ones might be stuck at near 0%. This week, with the Fed likely cutting soon, some banks might start trimming the top rates, anticipating funding costs falling. We saw a hint of that in the UK, where the average savings rate dipped slightly. So the pro tip is, lock in a good fixed rate now if you don't need immediate liquidity, or at least take advantage of high variable rates while they last. Some banks introduced new 12 or 18-month CD, certificate of deposit, specials at around 5% because they expect rates to drop next year and want to lock in your money now. On the fintech front, challenger banks, online-only banks, in the UK have been a success story. Just this week, Monzo Bank released its annual report showing it turned a healthy profit and has over 12 million customers, a one-third of whom use Monzo as their primary account. Monzo's profits soared nearly eightfold to around £115 million. Why does this matter? It means these app-based banks, Monzo, Starling, Revolut, though Revolut's banking license is pending, are here to stay and growing. They often offer consumer-friendly features, fee-free spending abroad, slick budgeting tools, early payday, etc. As they become profitable, they may expand offerings, like investments, loans, which gives consumers more options beyond the big legacy banks. Also, competition from them pressures big banks to improve their own apps and services. Starling Bank also, while seeing a profit dip this year due to one-off factors, is considering expansion, even an IPO abroad. So the era of neobanks losing money is ending. Now they'll look to attract even more users, possibly with better interest on deposits or innovative perks. If you haven't tried one, many people find them convenient for day-to-day spending accounts. On the more cautionary side, one mid-sized U.S. bank this week announced plans to tighten lending. Huntington Bank's exec said their auto loan business had strong months, but they're noticing a slight slowdown in payment volumes, hinting that maybe consumers are reaching limits. Banks might respond by being a bit more selective with whom they extend credit, so if your credit score is borderline, getting a new loan or card could become a tad harder. Also, credit card companies have been gradually tweaking rewards and fees. No bombshell changes this week, but there's an ongoing trend. Some are devaluing rewards points, others introducing new card perks to entice affluent customers. It's worth keeping an eye on your cards. If you have a premium card with a high annual fee, ask yourself if the benefits still outweigh the cost in this new environment of tighter belts. Retail and consumer goods. A notable corporate development, via Reuters, read next, tidbits, is Sainsbury's, a major UK supermarket, is in talks to sell Argos to China's JD.com. Argos is a big UK retailer, catalog store, that Sainsbury's owns. If this sale happens, it means a Chinese company would take over a familiar British retail brand. For consumers, immediate changes might be minimal. Argos stores would still operate, but maybe over time JD.com could integrate it with their online expertise or supply chain. It underscores how global corporate moves can filter down, perhaps better online shopping integration, or maybe different product ranges. It's something Argos shoppers might read about and wonder if their experience will change. Sainsbury's likely wants to focus on groceries and free up cash, while JD.com sees an entry to UK markets. Also in retail, a small cultural note: holiday shopping creep. Some US retailers, e.g., Amazon, Walmart, are poised to roll out holiday deals extra early this year, anticipating that consumers want to spread out spending or lock in prices. We've already heard of October Prime Day, again from Amazon. Corporate decision: start holiday promotions in October to capture sales early. For consumers, that means you might see Black Friday-like deals well before Thanksgiving. Good if you want to plan ahead, and may be useful given those Deloitte forecasts that consumers might front-load purchases due to tariff worries. So don't be shocked to see Christmas decorations in stores before Halloween. The retail calendar keeps getting longer. Tech and big employers. Tech companies often have fringe benefits or policy changes that can indirectly affect personal life. For example, there's been an ongoing push by many big employers to return workers to the office more frequently. This week, stories floated about certain companies tightening their stance on remote work. That's more of a workplace issue, but it has personal finance angles. Commuting costs go up if you have to go in more. Maybe you need to refresh that office wardrobe, retail benefit, or you consider job switching if you value remote flexibility. Lots of job switching happened in 2021-2022. Now power is shifting back to employers somewhat. Companies like Zoom, ironically, and Amazon have asked employees back 2-3 days a week. If you're one of them, your budget might need to add transit, gas, or lunch expenses again. Conversely, some companies are using remote work as a perk to attract talent without raising salaries as much. So, when evaluating job offers, the flexibility might factor in monetarily, less spent on childcare or commute, etc. Wages and corporate pay decisions. We touched on this with labor news, but to highlight a corporate move, Bank of America's wage hike. They reached $24 per hour minimum for their employees, on path to $25 next year. While that was formally announced last year and implemented in 2024, its effects are felt now. BOA employees, from tellers to support staff, have seen raises, which puts pressure on other banks to compete for talent. We may see similar moves by other large employers who set multi-year wage targets. For instance, some large retailers had pledged to get to $15 or $20 by certain years. This week didn't have a fresh announcement from, say, Walmart or Target, but those guys did big raises in 2023. What we might see soon, as we near 2024, are announcements of new wage floors in industries like hospitality and retail to attract workers in still short-staffed sectors, like food service. Keep an ear out. If you work in those fields, a raise might come not from you asking, but because the company decides to up the base pay for everyone to reduce turnover. Corporate moves in housing, real estate. One interesting note. Some major UK banks like NatWest and Virgin Money recently, just before our week, cut certain mortgage rates slightly, as swap rates, market funding costs, fell. So corporates in finance are adjusting product offerings. If you're a prospective homebuyer in the UK, the fixed rates available actually improved a little compared to a month or two ago. It's still high historically, 5% for a 5-year fix, but better than the 6% plus seen in the summer. Banks competently responding to anticipated BOE moves is a dynamic to watch. Another corporate aspect: rentals and landlords. Some large corporate landlords, in the US, think big apartment rights are companies like Invitation Homes that own many single-family rentals, have been in the news as they calibrate rents. Many saw that rents in the Sunbelt are no longer skyrocketing and in some cities are flat or down slightly from last year. So those companies are adjusting strategy, perhaps offering a free month to new tenants, or focusing on retention of current tenants with smaller rent increases to avoid vacancies. For renters, that's a slight relief. If corporate landlords ease off aggressive hikes because the market won't bear it, you might have more negotiating power or at least not face double-digit renewal increases. Insurance companies. We should mention in passing, in the US, some big insurance companies, State Farm, Allstate, etc., have been raising premiums significantly or even halting new homeowner insurance policies in high-risk states, California, Florida, due to huge claims from wildfires, hurricanes, etc. This week, Florida's insurer of last resort asked for a 12% rate hike. These corporate decisions to pull back from markets or raise rates dramatically are absolutely hitting consumers in those areas. Home insurance costs are soaring, which feeds into personal finance via mortgages. Lenders require insurance, and household budgets. If you're in a risk-prone area, expect letters about premium increases on renewal. It's an evolving crisis. Some homeowners are struggling to find affordable coverage. Corporations are basically saying climate risk is forcing their hand. It's more of a summer-long theme, not unique to this week, but certainly ongoing. Emerging themes and cultural shifts in money behavior. This week's news also shed light on some broader trends in how people are thinking about and managing money in 2025. These aren't single events, but rather ongoing shifts that have been building. Still, they surfaced in various forms in recent days, reminding us how the personal finance landscape is evolving. Frugality and financial anxiety are back in style. One unmistakable theme is a return, out of necessity, to frugality for many households. After a period in 2021-2022 where some consumers splurged with pent-up demand and extra savings, 2023-2025 brought them back down to earth. The Yahoo Finance, Marist survey we discussed earlier, where 1 in 3 Americans say their finances have deteriorated in the past year, speaks volumes. People are feeling the pinch of persistent inflation and higher borrowing costs. Culturally, this is manifesting in a few ways. Budgeting and tracking spending. Personal finance apps and tools report increased usage. Many individuals are now closely tracking expenses to find where to cut. Whether it's using old-fashioned spreadsheets or new fintech apps that categorize spending, the mindset has shifted from YOLO spending to every dollar has a job. Emphasis on needs versus wants. Households are prioritizing essentials. We see it in consumer behavior. Grocery spend holding up. You've got to eat. But discretionary categories, like apparel, home decor, electronics, softening. This week's cautious outlook from Deloitte for holiday spending underscores that families might focus on gifts for the kids. A need, in terms of tradition. But perhaps skip the second gift for adult relatives or forego high-end gadgets unless necessary. Growing financial anxiety. Nearly half of Americans in one poll described their local cost of living as unaffordable. In the UK, a huge portion of the population still feels like they're living in a cost of living crisis. That anxiety is a psychological shift. It can lead to more saving if possible, the rainy day fund mentality, and certainly more cautious spending. It's also leading folks to seek advice. Financial literacy content is in demand, e.g., TikTok and YouTube have many creators giving budgeting tips, though quality varies. The general public's money worries have even become part of pop culture conversations, like memes about how expensive everything is now. The rise of Gen Z finance habits. Another cultural shift is coming from the younger generation entering adulthood, Gen Z, roughly ages 18-26 now. A Yahoo Finance feature this week highlighted 6 Gen Z savings strategies that can work for anyone. This points to something interesting. Despite stereotypes of Gen Z being spendthrifts or only into YOLO experiences, many Gen Z individuals are actually quite money conscious and creative in saving. Some trends and behaviors attributed to Gen Z, which others are learning from. Side hustles as norm. A lot of Gen Zers don't rely on a single income stream. They might have a main job and a side gig, anything from freelance design to DoorDash to an Etsy store. This hustle culture is partly driven by economic need, wages versus living costs, and partly by digital nativity, easy to monetize skills online. Older generations are taking note. Many millennials and Gen X are also picking up side gigs or turning hobbies into small businesses for extra income. It's become more culturally acceptable, even cool, to have a grind outside your 9-to-5. Digital tools for finance. Gen Z grew up with apps, and they use fintech tools readily. Auto-saving apps that round up purchases and save the change, stock trading apps for dabbling in investing, budgeting apps with visuals. These are second nature to them. This week's news didn't specifically list apps, but the subtext is that personal finance tech is booming largely because young people demand it. Banks and fintech companies are tailoring offerings, like early direct deposit, no overdraft fees, fee-free stock trades, which benefit everyone else too. Investing early, but cautiously. Some Gen Z folks started investing during the pandemic stock craze. Remember the GameStop saga of early 2021? After some got burned by meme stocks or crypto volatility, the trend has shifted to more cautious, long-term investing approaches. There's a growing movement of young investors who are into low-cost index funds and ETFs, basically embracing some of the wisdom that older generations had to learn. The cultural aspect is that talking about investing is more mainstream now in social circles. What used to be boring 401k talk is now on TikTok, with varying accuracy. This democratization is good if it spreads sound advice, though risky if bad info circulates. Values-based spending. Gen Z is also known for spending in line with their values, sustainability, social causes, even if it costs more. But ironically, when forced to be frugal, that sometimes means thrifting, which is sustainable and cheap, or buying second-hand tech, etc. The thrift store and resale economy, e.g., Depop, Poshmark for clothes, Facebook Marketplace, is thriving, which aligns with both Gen Z's budget constraints and eco-mindedness. It's become cool to brag about a thrifted outfit or a marketplace furniture find, whereas 2 decades ago some might have seen that as low status. This attitude helps normalize saving money as a positive lifestyle choice, not just a sacrifice. Embracing tech and efficiency to save money. The pandemic accelerated some trends like grocery delivery, remote work, telemedicine. Some of these can save money, or time, which is money. Now in 2025, people are optimizing. For example, using price comparison browser extensions religiously when shopping online, or leveraging the plethora of subscription services smartly, alternating streaming services instead of paying all at once, etc. A cultural tip that floated around this week. Many are doing subscription audits, going through their bank statements to find and cancel unused subscriptions. This became a bit of a social media challenge. Share how many subscriptions you canceled and how much you saved. It's anecdotal but shows a mindset of cutting waste. Shifts in housing and living arrangements. Culturally, because buying a home has become so expensive in both the US and UK, high prices, high interest rates, more people are delaying homeownership or exploring alternative paths. In the US, the average first-time buyer age hit a record high, like 36. Not a one-week story, but years of price run-ups and now mortgage rates tilde 6-7% mean younger adults are renting longer or living with family. Multi-generational households have ticked up again. This week's Renters' Worry survey in the UK aligns. People might stay renters for life if owning seems unattainable. The cultural acceptance of that is growing, whereas older generations viewed renting past a certain age as less desirable. On the flip side, it's fueling a trend of co-buying or co-living. Friends buying a house together, seen in some millennial cases, or siblings teaming up to purchase a duplex, etc. Real estate companies and mortgage lenders are even adjusting some products for shared ownership structures. There's also a renewed interest in relocation to cheaper areas. Remote work enabled some to move to lower-cost regions. Even with some return to office, the idea that you could leave an expensive city for a place where your money goes further is tantalizing many. We see migrations in both countries, e.g., Americans moving from pricey coasts to Sunbelt or Midwest, Brits moving from London to Northern England or rural areas. This trend, flagged in various economic reports, continued into 2025 and is part of dinner table conversations. Maybe we should move somewhere cheaper for a better quality of life. In short, US trade and EV policies could nudge prices higher, while UK regulatory tweaks aim to streamline payments and keep banks fair for consumers. In video 2, we'll jump into the corporate side, banks, fintechs, retailers, tech, housing, insurance, and then zoom out to this week's cultural money shifts and our full week wrap-up.